Hey, hello, everyone, and welcome to Mindset to Mastery, where we make investing simplified. Is the Canadian housing market about to boom, or are we heading to a crash in 2026? Between massive mortgage renewals, a shifting job market, and new data from Canadian Real Estate Association, the experts are divided. Most people are guessing, but today we are looking into real metrics. I have analyzed reports and industry insights to give you an unbiased look at what's actually happening. Whether you're a buyer, a seller, or an investor, you need to see through these numbers before you make your next move. So let's dive in. We just closed out 2025 and it was one of the slowest years in a decade. We saw buyers fled to the sidelines early in the year due to tariffs. A small rally happened during summer, but then a stall to finish happened towards the year on the end. National home sales dropped 2.7% in December alone. Overall, transactions for the year were down nearly 2% compared to 2024. Prices have cooled off as well. The housing price index is down 4% compared to last year. The average home prices in Canada now sits at roughly $670,000. If you're waiting for the slight dip, it has already happened. The market has effectively reset. What it means? It means that the era for frantic appreciation is now over. We start with 2026 from a flat line. Now let's analyze the market from a supply standpoint. The inventory in the market is rising. It's not just seasonal, it's structural. The official data suggests that there has been a 7.4% increase in the supply from an year ago. This increase in inventory is huge. There is a huge wave of mortgage renewals that is hitting in 2026. People who bought when rates were 2% or 2.5% are now renewing at around 4% or higher. This 1 to 2% jump can break a monthly budget. We are also seeing two types of sellers currently entering the market. First, it is the homeowners who simply can't afford the new payments, or we have over leveraged investors who are underwater. Many investors who bought properties at around 500,000 are now worth 400,000. There is no equity left to refinance, so they are forced to sell. And this is why inventory is projected to keep climbing through 2026. So, what does all of this mean? This means a supply wall is building. Without a demand spike, prices are expected to fall in order to absorb this effect. Now, similarly, let's analyze the demand side. So, from a demand standpoint, while the institutional view, like CREA's view for 2026, is a bull case scenario where they expect the sales will recoil because of the pent up demand, the market reality is actually different because it's not just about interest rates, it's also about job market, job security. We know that this is an era of AI integration. Companies are realizing that they can do work that earlier took 10 people with only 4 to 5 highly skilled people. The national employment currently is around 6.5%, but experts are saying that it could climb to 7% or even 7.5% as the companies adapt. When people lose jobs, they don't buy houses. In fact, there's a high chance 2026 will have fewer buyers than 2025. We also have to talk about population because that's where the demand comes from. For years, immigration fueled housing demand in Canada. But government has now put caps on students and temporary visas. People are actually leaving the country and PR targets are being reduced. How does this impact you? Well, if you are a landlord, this is a wake up call. You can expect higher vacancies unless you play it smart. You can't just put any property on the market right now and expect people to come in and rent it right away. They have options now. So you have to be smart about this. And lastly, it all comes down to affordability. which remains suppressed as we move into 2026. So, what's our final verdict? We expect demand to be lower in 2026 as compared to 2025. Let's try to figure out what kind of a market we are in currently. Is it a buyer's market or is it a seller's market? The data says it's balanced. The sales to new listing ratio is currently 52.3%. In terms in simple terms, anything between 45 to 65% is considered a balanced market. We currently have 4.5 months of inventory. To put that in perspective, a seller's market is anything under 3.6 months and a buyer's market is anything over 6.4 months. We are right in the middle. So, less demand plus more listings usually mean one thing: prices could continue to decrease. Hence, my forecast is 3 to 5% drop will happen in 2026 as compared to what we saw in 2025. So with all that said, let's summarize where we are at. So 2026 essentially opens with a tug of war between institutes like CREA optimistic about the upcoming year, whereas the structured inventory and the structured reality says a different story. The market is balanced, uh, but we do have indicators that suggest a supply wall will be formed by mortgage renewals, investor exits, and this could suppress the prices further. We have clear indications of stalled momentum. We see there is a supply risk. And because of all these factors, we have to be smart about our playbook and our strategies for 2026. So now let's deep dive and break down how uh, an investor, a seller, or a buyer should plan for their next moves as we move into 2026 in this market. So first of all, let's look at the strategy for the buyers. So for buyers, they need to follow a strategy which I call as a volume shooting strategy, where they start with a large number of properties, say 50 plus. They have they have to make offers, and when they are making offers, they don't have to make them at the today current market value, but they should factor in a potential further drop of 5 to 10%. Why this is important? Because if the market drops, you bought it at the bottom. But if it stays flat, you have instant equity. So, so critical role over here is for the realtor because you have to make sure that you are working with a realtor who's willing to write those 30 offers until you stick with one. Overall, the implication for you is in this market, don't think about uh, the fact that lowballing is considered rude. For you, it's a strategic necessity. You have to safeguard yourself and you have to factor in the risk that you're taking if you are a buyer in the current scenario. Next, for sellers. For seller, the theme is simple. You need to sell early to beat the inventory glut. You have to be very cognitive about the timeline here. Why? Because if you need to sell, and it is that you definitely need to sell, you should do it now. February and March are often better than waiting for summer rush because there's less competition now compared to what you'll have later on. Make sure your marketing is top tier because lazy real estate listings aren't selling in this market. Active promotion is required and you have to stay on top of it. So make sure you have a good team, a good realtor who's not just listing your property on MLS, but he's investing his time and effort in making sure your property is getting the required views and is promoted actively. So for you, if you want to sell, list it in Q1 before the crowd arrives. Timing is the key, focus on that. Now, for investors, it's pretty interesting because we have uncertain times right now. So for you, it's very important to skip or avoid the negative equity trap. Why? You know what happened. properties that were bought 3 to 4 years ago are now often facing lower valuation than the price at which you purchased, and you have a negative cash flow, right? So your strategy should be first to audit your current portfolio. You should offload all the negative cash flowing assets right now. Why? Because in this market, I would not recommend you to keep holding on those negative cash flow assets with the hope that they will perform automatically with time. Okay, if you if you if you can, I would say you should first get rid of those properties or de-risk your asset portfolio. Then, instead of hoping for value to be created, you'll have to create the value for yourself. How? You have to focus on value driven strategies like BRRRR, which is buy, rehab, rent, or refinance to create value and not just wait for it. And lastly, you should look for ways to build 20 to 30% equity through construction or creative design to protect yourself against market corrections. Because we have to prepare for the worst, but of course, with the right strategy in place, we can always minimize our risk. So for you, risk management is the key. To summarize, for investors, I would say passive investing is dead. 2026 rewards active value creators. But whether you are an investor, a buyer, or a seller, you all have to factor in the macro risks that are at hand. We all know we have risk with regards to technology, where AI is disrupting the market. It's impacting the demand side by uh, by reducing the number of jobs that are currently there in the market. Then we have policy risks. We know there is heightened tensions with US. We have tariff related discussions going on, and recently Trump said, or Trump threatened to put 100% tariff on Canada because of the deal or the policy that they have created with China, the trade deal, right? So we have to be cognitive of all these risks. There are caps on students and visas, which is lowering the total population. So the demand side, we can easily see it's going to reduce. The last thing is interest rate reality. So currently the interest rates are stable, but historically they are high as compared to the entry points for most of the current owners, because of which there would be a renewal shock coming in 2026 when they have to refinance and renew their mortgage. So take all these factors into account when you are planning your next steps in incoming year. So in all, I would say there is no soft landing guaranteed. External variable could shift the floor, but with the right planning and risk management, you can make the right steps and make the best out of this market that we have right now. In order to help you, I have created a checklist that you can see on your screen. It's for investors, sellers, and buyers. It contains all the points that we just discussed, and I would recommend you to use this slide as a reference point for the next 6 months. Make sure you are addressing all of these and you're making an all-round strategy for yourself. So, final thoughts. I think for 2026, we have to be cautious. It's an year of correction and consolidation, not boom. The 2026 market will belong to those who have the best data. We have 4 years of pent up demand, and interest rates are likely as good as they're going to be for a while. But with job uncertainty and high inventory, you must be very careful. Don't get emotional, get analytical. It's an active market where value is created through negotiation, speed, and forced appreciation. With that said, I thank you all for listening to my video. If you found this information helpful, please hit that subscribe button. What do you think? Is 2026 the year to buy or the year to wait? Let me know your comments, please, and see you in the next video.